officially summer. Not really. Feels like it. Welcome back, everybody. It is 11:07 on May 19th, 2026. We've been pretty busy, you and I.
Yeah, we've been really busy.
Separately. I mean, like, well, work-wise together we've been busy, but
It-
fun-wise too, we've been busy.
yeah, you gonna talk about PGA at Aronimink?
Yeah, something I'll share real quick. This is pretty cool for you golf fans out there. I was at Aronimink this past Saturday on I guess that was the 16th at the PGA Championship. I'm lucky to have that right in our backyard this year. And this is Scotty Scheffler. That is not zoomed in. That is as close as I got to him, right on the fairway there, at the fence by the fairway, with his caddy. And then this is Rory McIlroy. Rory
That is
McIlroy.
cool.
I always have problems pronouncing his name.
Yeah, it's a toughie. Just the first name, Rory's tough.
Not zoomed in, but it was awesome. They had this app you could download where you could track the golfers, and I'm sure for those of you who have gone to events before, PGA events are probably saying, yeah, duh, of course. But you could track where they were and anticipate them getting to the certain hole or fairway, and you could watch them walk right by you. It was really cool.
That's neat, man.
It was a
had.
really awesome time. Perfect weather, free food, free non-alcoholic drinks, and they say, before I went, they always said that people I talked to who have gone to PGA events before said that most of the money that they make is, well, one, on ticket sales, and two, on merchandise, because a lot of the merchandise you can really only get there at the PGA events. So I caved, and I got a club cover. It was an Eagles
Oh, I love
club cover, Kelly Green, and
Let's see the other side.
I couldn't help myself, So
What's it say? 108th PGA?
108th PGA. It's got Aronimink on there. Kelly Green Eagle. Anyway, so yep, I helped
That's
that
great,
statistic out a little bit.
Good job. Well, now you got me excited. I want to go to one of those events. I mean, that was special because it was the championship. What'd you say the last time the championship was there was what? 50,
I think it was
60?
1968. It was the last time
Oh
it was
my
at
God.
Aronimink. I think we Googled it. We Googled it when we were there.
Yeah.
And
And it was you and Connor who went, right?
Yeah, me and Connor. It was such a great time, and the weather made it great. Course was easy to walk. We walked a lot though. I think we ended up walking at least 5K, at least 3 miles by when it was all said and done. But it was, you couldn't tell. I mean, it was just, there was so much to look at and see, and it was a great day. Yeah.
That's great. Good for you. You got to do those things. That's awesome.
Yeah.
All right, we did do something together, and it was this. Does that look familiar?
That does. That was a great day. It's Mother's Day.
For Mother's Day, Kirsten wanted to go hiking. We went up to Hickory Run State Park in Pennsylvania, and it was great. We hiked 2 trails. One was called Shades of Death. I can't remember if this one was Shades of Death Trail, but it was great. Waterfalls, lots of nature, pretty uncrowded. It was really fun.
I don't think that was Shades of Death. That was
The first one. I forget what that was
something
called.
Falls.
Yeah. I forget the name because the name's not as cool as Shades of Death.
No, it's saved in my All Trails app because I tracked this on that one, but
Yeah.
that's not Shades. That was a cool waterfall though.
Good time.
It was a
We had
great day.
time. Yeah, it was a great day. Then we went into Jim Thorpe and had some fun at Jim Thorpe. So good day. Yeah.
Which Jim Thorpe was way more crowded on Mother's Day than I thought it would be.
Yeah. Yep. Jim Thorpe was packed.
Yeah.
Little mountain town. Hey, real quick before we go on to another slide. So check this out. I was, I guess I've been doing this career for decades upon decades, but I remember this. I saw it pop up on my Twitter feed today. In May 2000, so 26 years ago, a Japanese trader at Mizuho Securities tried to sell 1 share at 610,000 Japanese yen and instead sold 610,000 shares at 1 yen due to a typo. The Tokyo Stock Exchange couldn't cancel the trade at the time, and the loss for his firm was $225 million on one fat finger mistake. You imagine $225 million because you mixed up the shares and the yen that you were trying to trade.
Did he retain his employment?
I don't remember. I remember when that happened because remember it's May 2000 and people already complaining about technology and the internet. I remember one guy saying, technology is not wisdom. It's not an accelerator. It just enables people to be wrong faster. And this is a great example of that. I mean, a really expensive mistake. $225 million too. I mean, that's probably $500 million in change right now in today's dollars. So amazing. All right.
I have a good segue into that actually. So this is from ChartR right here. And it shows the early internet search engines have been eclipsed by forums and AI chatbots. So basically saying, hey, all of these search engines that emerged from the 2000s, from the dot-com bubble, dot-com era, I should say. Just a few, if you're listening to quote as examples, Google, Ask Jeeves, Ask.com, Yahoo. Their usage is being eclipsed by Reddit, Claude, Grok, and Gemini. And except for Reddit, the Claude, Grok, and Gemini have skyrocketed in just the last year or two. But really showing how a lot of these search engines are being taken over by the forums and AI chatbots.
Yeah, look at that. Well, Gemini is Google's
It's
AI.
Google, I know. It's not really comparing companies. It's just comparing the method for searching. It's just a better mousetrap, I guess you could say.
Nobody's searching on traditional, well, not as much on traditional search engines. Like Ask Jeeves is flatline. I mean, that cracks me up. But this also shows, and the Google search on Google's traditional search is plummeting while Gemini is soaring. It also tells you why. I forget if that was like 2-3 years ago. Do you remember the big shots at the top of Google were freaking out at an internal meeting that got leaked about how they were worried they were falling behind on AI and how their whole business was going to get consumed by someone else. And so they launched Gemini, and they were right to be panicked because you can see even their own searches are being cannibalized, but they're making up for it by having Gemini be the new search. So
that's what's interesting, is seeing these companies who own the search engines and also own the AI chatbots, like Google, for example, with Gemini and their own search engine, and that shift, because it is a drastic shift. I mean, yeah.
Interesting. All right. So, something very true. If headlines predicted stock markets, then journalists, especially business journalists, would be hedge fund managers, and they'd make millions and buy private islands and laugh at all of us. So this is a really good example. So headline in late March 26th from CNBC, on the heels of the Iran war being in place for a little bit of time, and it says Dow slides more than 450 points, pressured by rising oil prices and doubts over Iran negotiations. Well, we've still got those headlines now, but at the time, that headline is just compounding the pain, and they're just reporting on the past. And it's this headline, I deliberately overlaid it on a chart of the S&P 500 since that headline. The market at that point was down about 7% from its all-time high. And since then, it's actually up more than this chart I created. But it's on this chart, it's up 8.5%. So basically, if you read that headline on March 26th and said, that's it, I'm selling all my stocks, it just rebounded 8.5% from there, and it's actually up even more so as of today. So do not. You hear us say this all the time, but the headlines are reporting on the past, and sure, it could have gotten worse. It's just a great example. I'm cherry picking a little bit, but a great example of where you got to watch. News-driven portfolio decisions are some of the worst decisions on most of the time.
Do you think it was? I mean, you're an elder to me.
I'm an elder.
Old. Do you think you have more experience on this earth? Do you think it was more? It was easier to buy and hold and not be pressured into selling based on news-driven fear back in the 60s, 70s, and 80s, when we didn't have news in our pockets or on a TV all day in front of us or on a computer. You had to go buy a newspaper, or you really had to go to the exact channel on the TV. It wasn't just screaming in your face.
Correct. Yeah. So absolutely. I mean, you can create a lot of panic or a lot of greed in people just by constantly screaming things at them. The other thing is, we're humans. A lot of humans want confirmation bias. They want to, I believe X, I'll go to imright.com and, oh, look, it says X is correct. I'm right. So I'll act irrationally based on that feedback loop I'm getting. And meanwhile, I'm inside a bubble and I'm not actually getting good information. I'm just getting information. So yeah, it's a real problem. We see that as we deal with our clients. Not all of them is a small select few, but it's a little tough sometimes because you can tell by their breathless start to a phone conversation that they've been consuming so much news and they're all worked up. And it's almost like we got to deprogram them for a little bit, to say, wait a minute, hold on, let's back up a second and just talk logically and about math and about cold calculating statistics that don't really care about what some biased news media, because let's face it, news media is biased these days. Most of it is biased. Left, right, up, down, greed, fear, I don't care. It's mostly biased because they're trying to sell something, and that's more media. It makes it tough. Makes it really tough.
Fear sells. Good news.
It does. Fear
Good news
really
rarely sells. Yep.
Yeah, greed sells, but not as much as
as much as fear.
No.
Yeah.
No.
Yeah. Well, again, trying to segue off that here. This is from A16Z News. First one, well, really from JP Morgan, I should say. The fastest market recovery ever. So this, if you're listening, is a chart that shows the days that the S&P 500 took to recover from a 10% loss. And it's highlighting how this recent one in 2026, and they've labeled it Iran conflict, took 11 days. The S&P took 11 days to recover from a 10% loss. Comparing that to last year in 2025 with the tariff tantrum, that took 55 days for the market to recover from a 10% loss. COVID-19 in 2020, that took 103 days for the S&P 500 to recover from a 10% loss. And it shows a number of other, the dot-com crash, for example, it took over 1,100 days for the S&P 500 to recover from a 10% loss.
Greater than 10%, yeah.
Yeah, this is just at least 10, greater than 10%, I should say.
Yeah.
But I mean, just kind of going off your point there, it's amazing how quick this recovery was, and especially given how horrible the news was surrounding it. If I showed this chart to someone 2 or 3 months ago, they'd think I'm crazy, and there's no way.
Yeah, 11 days. I mean, if you're using news to make buy and sell decisions, and they tighten that window up to 11 days, come on. It makes it almost impossible to use news. I mean, it's already impossible. Now it's become even more so. Yeah, it has been fascinating how quickly these up and down cycles they've been compressed into these little windows of time instead of extending out. Now, I'm sure at some point we'll get an extended bear market. It'll take longer to recover from. I mean, it's inevitable at some point. But the recoveries off these lows. That happened last year. It's right there, the tariff tantrum, 55 days, right? I mean, 55 days, that's so fast. I mean, we were down for basically 2 months and then right back. I mean, it was or a month really and right back.
Yeah.
Pardon me.
I get it. We've been in for the last number of years, especially in the 2020s, a really good, I'll call it a bull market. But it hasn't been without volatility, and it's not like it's all been sunshine and daisies. It's been tough. There have been, if you have held through these past 5 or 6 years, you have had to endure some steep down cycles. They've been short-lived, but my goodness, they've been scary.
Yep. Yeah, they really have. So, market gets to an all-time high recently again. And I know, and I don't blame people. A lot of people say, I'm not going to add money here or buy stocks here because they're at an all-time high. That must be the dumb thing to do. I'll just wait and buy the dip. And the truth is that, buying the dip feels smart. It feels better buying when stocks have just fallen. But buying the top tends to work anyway. So this image I'm showing you from Carson Investment Research, it goes back 75 years. And it's basically showing, okay, you got two choices. You could invest at the all-time high, or you could invest on all the other days other than the all-time high day. And whether you're looking at the average return a year later, 3 years later, or 5 years later, the returns are pretty darn similar. I mean, whether you're buying at the all-time high and you wait a year, 3 years, or 5 years after that point, or instead you buy on any of the other days that aren't an all-time high, looking forward, your returns historically have been pretty darn similar. It's new highs beget new highs, over time. So
Is that because of momentum?
I think it's just because, I mean, sure, you're going to go through long drawdown periods. So you go through a 3-year bear market like 2000 through 2002, then you're going to go, yeah, buying all-time highs is stupid. But most of the all-time highs don't end in a period like that. So the data ends up stacking up on the side of, listen, just when you have the money to invest it, because you're probably not going to be able to time it perfectly.
Yeah, that's interesting. I've seen charts like that before, and you and I both know that it's just every time you see one, you think intuitively as humans doesn't make much sense, but it's true.
Yeah.
It's the stats. Um, Tim Cook no longer at Apple. I know that's somewhat old news by now, but I like this chart. Apple investors got $4 trillion richer under Tim Cook, and this shows Apple's year-end market cap from 2011 to 2025. And I mean, I know it doesn't show it on this chart from Yahoo Finance, but this has definitely has got something to do with all the stock buybacks that Apple did, right?
It does, but
That's only one piece. I know it's a massive Mag 7 company. It's just that was. I mean, they're making their shares scarce.
yeah, it's a big piece of Apple's price going up. Is Apple, the company, was buying back their own shares and therefore making the rest of the shares more scarce. And that's just simple supply and demand. But the thing is, to buy back your own shares and not accumulate debt, which is exactly what Apple's done. If you're going to borrow to go buy your own shares, well, that's one thing. But if you're just going to take it from cash flow, that's a better thing.
Yeah,
And that's what Apple did under Tim Cook. I mean,
because
Tim Cook
they were
said, "We're
making so much revenue. They were making
Exactly. And I will tell you, when Tim Cook came in, I thought, there's no way. I mean, who's going to follow, who's going to follow Steve Jobs? I mean, come on. And Tim Cook comes in, and I was wrong. He really lit it up. He did quite well. I mean, people argue that Apple hasn't innovated enough in a while, and I think we've heard that argument over and over for decades with Apple, even when Jobs was there. But Tim Cook really has done he really did a great job. So now we wonder what's next, but really impressive.
Listen, this is so much time. This is so much time.
Yeah.
A decade and a half. You go back to 2011. I mean, I'm sure it was still a lot of people, but really, how many people had an iPhone in their pocket today? If you see someone using a phone that's not an iPhone, at least in my view, it's out of the ordinary.
It is at least here, correct?
Yeah, yeah. In America, in Pennsylvania, at least, in my little circle of life, it's usually an iPhone's in someone's pocket if they own a cell phone.
Yeah, and they created an entire ecosystem that draws everybody in and keeps them there. It's really Apple Music, iWatch, iPads, Mac computers. It's amazing what they've done. So this is your simple recurring reminder not to mix political decisions with investing in stocks. So Capital Group, also known for their American funds, mutual funds, updated their, it's originally from Schwab, but Capital Group puts it in this format that's really easily readable. They updated this image that basically shows the stock market since 1961 and shows it going up and to the right with hitches along the way. And they've color-coded it for blue and red for who was in the White House, which party was in the White House, Democrat or Republican. And they also listed each of the presidents atop each of their periods of time. And if you're just listening to this podcast and not watching on YouTube, the general idea is that, generally stocks go up over time, regardless of who's in the White House. It's not perfect all the time. Yes, a president's policies do impact the markets, but the degree of impact is less than you're factoring in if you really, really are focusing on the politics. And it's even been updated for the most recent for Trump's most recent second term. So just an amazing thing. $1 invested in the stock market in 1961 has grown to almost $1,000 in value, and it mostly didn't matter who was in the White House.
Yeah, I mean, it's just speaking from personal work experience here over the last, I'd say, 3 or 4 years alone. On both sides of the aisle, I've had conversations where it's amazing how many people really believe that the president of the United States has their finger on the exact pulse of the US stock market and controls its every movement. It couldn't be further from the truth. Like you said, yes, some policies do impact the market in some ways, but there are so many factors that play into the price of stocks, and politics is a very small piece of that data.
Yeah.
It's
billions of pieces of information are flowing every day that have nothing to do with politics that also influence stock prices. So it's a part of it, but it's not nearly as big a part as most of us think. It goes back to the media. The media kind of talks about politics a lot because they know it gets a lot of clicks and views and so on. And then people translate that into the capital markets, and it's not an easy or useful, translation.
No, not at all. Yeah.
Yeah.
Great chart. I've got one that's I think is pretty interesting here. So I've been hearing a lot of.
Can I do one more real quick?
Yeah, of course.
Just one more, because it plays with that.
Yeah.
The politics and stock market thing. So just real quick. Sorry, Keith. I forgot I had this too.
No problem.
So this is from Peter Maluk at Creative Planning, and it basically is a image showing the growth of $10,000 invested in the S&P 500, the stock market, from 1953 to just 11 days ago. And if you just invested $10,000 in 1953 and just kept it in there, today you'd have a little over 25 million bucks. If you said, you know what, I'm going to do the same thing. 1953, I'm putting 10 grand in. But if there's only a Republican, I'm only going to leave it in there. I'm only going to have it in there when there's a Republican president. Well, instead of having 25 million bucks, you only have $363,000 approximately. If you said, well, I'm going to do the same thing, $10,000 in 1953, but I'm only going to have it in there if we have a Democrat as a president. Well, you have $692,000, which is better than under the Republican presidents, but both of them are a long ways away from the 25 million if you just left it alone. So this is another one where if you mix politics with investing decisions, historically it's resulted in complete disaster.
This is a little silly, but in my opinion, basing whether or not you're investing in the stock market off of which party is in the White House is no different than basing whether or not you'll invest this year in the stock market based on whether an AFC or an NFC team won the Super Bowl. It's no different. It's this.
That's how I do it.
There's no reason to do that. Leave politics out of investing. That's
I agree.
One of the best pieces of advice. But no, that's another great chart and good parallel. So a lot of talks lately. Hey, AI bubble. Is there an AI bubble? And I thought this was really interesting from Phil Rosen. He says, if you're just listening, he says, talking about an AI bubble doesn't make sense when tech stocks are actually getting cheaper. The forward 12-month price to earnings for the S&P 500 tech sector now sits at 23.6, down from its peak above 30 last fall. So what he's saying is tech stock valuations this year are actually more inexpensive than they were last year, yet everybody's screaming, hey, there's a tech AI bubble that's on the horizon. Generally, to have that, you've got to have tech stocks be relatively expensive, and they're looking cheaper, in other words.
Yeah, it's like you can have price go up, but if earnings go up faster, then that stock is technically less expensive because the engine driving the company is getting bigger and more powerful.
Yeah. Tech valuations have declined based on improving earnings. I think this isn't to say an AI bubble's completely ruled out, at some point. It's just, all the talking heads saying it's coming right now. We're on the cusp of it. This would point otherwise.
Yeah, there's a whole lot of, this is the late 90s, this tech bubble again. And I don't doubt that sometime in the future we're going to have that same type of occurrence, but this is not it yet, because back then the majority of those tech stocks were priced, as if they'd already earned the next 10 years worth of earnings, and we're seeing the inverse of that right now. They're just not priced like that. Most of them, a small handful are, but most of them are not.
Yeah, the sector as a whole is just not.
Yeah, exactly.
The general sector,
Yeah. So I'm gonna butcher this guy's name, but he wrote a really cool Substack. Substack's a great thing. You guys don't use Substack, but independent journalists write on Substack, and it's really, you get away from the bias of the media when you use Substack. You can get away from the bias of the media. So this gentleman, Rishi Pethe, forgive me, Rishi, if I've just butchered your name, but he wrote this great article called "The Case of Missing American Mushrooms: Why the U.S. is Missing 1 million pounds of mushrooms a week." And this is fascinating, the chart he included in here. Did you know that of all the mushrooms produced in the United States, the vast majority of them are produced in Pennsylvania? Did you know that?
I didn't know. I had no idea. I know we have a lot of farms, but I did not know that. I would have guessed Idaho or something, or Iowa. I don't know, somewhere out there. But what do they mean by missing?
So it basically, there's been a reduction in the amount of production of mushrooms, and
okay.
it got a little technical and a little dry, and I read through it anyway. But that wasn't really the thing. I mean, it's fine unless you're in the mushroom business. You probably don't care about that much. But I just had no idea. I mean, I always picture it being somewhere else. So like California is pretty big on this chart. They produce a lot of mushrooms. Texas too. There's a few other random
Oklahoma
states.
makes sense. I mean, but. Yeah, Pennsylvania. I had no idea. And that's a huge dominance there from Pennsylvania.
Pennsylvania basically grows the bulk of the mushrooms made in the United States. So, and he wrote in the Substack, almost 69% of U.S. mushroom production occurs in the borough of Kennett Square, PA. Now, we know, you and I know it's mushrooms down there. We know, you can smell it.
I do know that. I mean, I wouldn't have guessed that much. But
So almost 69% of U.S. mushroom production occurs in the borough of Kennett Square, PA. It is a small town of about 6,000 people, but mushroom growing facilities around town produce almost 451 million pounds of mushrooms annually. Farm to table, more like Kennett Square to everywhere, is what he wrote. So fascinating, just a silly little thing, but a lot of our clients are in Pennsylvania, the surrounding states, and just something I thought was, usually we're in the middle of the pack or somewhere else, not interesting for most things, whatever it is you're looking at. But this is something very strange and unique and quirky that Pennsylvania does.
I might have to get a little side gig as a mushroom farmer in Kennett Square. That's not too far down the road. That sounds like a lot of work, actually. I'm sure that's a ton of work.
I don't think that's hard work.
That's
smelly, dirty work, man.
Yes, yeah. So I'm not usually one to, off the bat say, "Oh my gosh, prices are getting insane." But lately at the gas pump, it's been a little bit like that for me. Maybe I've just been doing a lot of driving lately, but it got me curious, and I looked at this piece from Charlie Bolello from Creative Planning to see, really just since 2026, how much the average price of per gallon price of gas, unleaded gas in the U.S. has gone up. $2.83 a gallon was the average price per gallon of regular unleaded gas in the U.S. in January 2026. Only a short 5 months later, it's at $4.56.
Ooh,
which,
I mean, a big jump.
Again, I'm usually not one to comment on this stuff, but the pace at which that went up was just so fast. I mean, I've lately found myself pulling up to the pump going, it just keeps going. It just won't stop.
Yeah, I've had that same feeling too. It is pretty remarkable. Yeah, I don't know what to say. I mean, and the funny thing is, it always feels like when there's an oil price shock, gas prices immediately surge, and then when oil comes back down, they just bleed lower, trickle over time. So, for the next podcast, I have an image of the inflation-adjusted price of gas over like the last, I think it's 50 or 60 years, and I'll bring it. It'll shock you. Basically, you'll go, whoa. I mean, you haven't been alive for 50 or 60 years, but on a relative basis, gas really hasn't gone up much in price compared to inflation. If it had tracked inflation, I forget where it would be. It would be $15 to $20 a gallon, and that would be normal. That wouldn't be oil price shock level. So
show me that. That'd be interesting. I want to see that next time.
I have it. We're humans, so we remember our most recent experience. But you look back, you go, wow, gas should be higher just using inflation as the gauge. Yeah. All right, I have a fake listener question, and I say fake because I wish somebody would ask this, and I bet you do too. So I'm going to say, here's what I wish somebody would ask for a listener question. What mistakes do families make after an inheritance? So an older person passes away and they give a bunch of money to, for example, the son or daughter. And usually the son or daughter, for most people, it's a lot of money on a relative basis because, the older person has more and the younger generation less and so on. And so it suddenly feels like a lot of money. So what mistakes do people make with that money? Well, you kind of heard these before, sort of, but man, we see it, you and I, Keith, our whole team, we see this all the time. A lot of times these people assume that amount of money, because it feels so large, will last forever. This windfall will last forever. So they start spending. They start spending on things that they've always wanted or always wanted to do. And some of that's not bad. Your loved one would probably want you to do some of that, but they usually take it too far. So they spend the money too quickly before they really understand the full picture. Making emotional decisions when they're still going through grief. One of the best pieces of advice I got when my father passed away was don't make any emotional decisions for at least the first 3 months, if not the first year. Just step back. Don't make big decisions. Just go slow, because it's really not, you're not really built to make those decisions right now. Failing to understand the tax consequences. People will start spending this money and then later go, wait, tax on certain things I did? I didn't realize this. So that's a biggie. And then letting the money get in the way of family relationships. We see that a lot too. Maybe it's two siblings which are going to inherit the money, and all of a sudden, a week or two after the family members passed away, they start fighting and start creating problems. So just take your time. If you inherit money, go slow, think about it. Don't make any big decisions. Map out your plan. And trust me, you'll probably have enough time to do the things you want to do later.
Yeah.
Anything else on that? Did I miss something?
No, just that that's a big part of my week is for both clients and non-clients is guiding people through inheritance, sudden inheritance, because it's for most situations, it can be a unexpected and emotional time. And like you said, it's balancing that with, hey, now I have to help settle this estate and, find a way to efficiently manage this money. And again, whether you're a client or not, we're always here to help and answer questions if you have them.
Yeah.
It's a big part of what both of us, or of what our whole team does every week. So, no, that's good. That's good. I wish people would ask more about that. I think people don't because it's sad. No one wants to think about that. No one usually, inheriting money. It involves someone passing away, probably someone they love very, very much. So no one wants to consider that.
No, it's hard to talk. Yeah, no, I get it.
It's I don't want to say easy for us, but maybe easier just because it's a big part of our job is helping guide people through sudden inheritance. But for the average person, it's something that they stuff in the back of their minds and never really want to bring up. And that makes sense. Who wants to think about that?
And that's why I made a fake listener question.
Yep. Yeah.
Yeah, I had a few other listener questions this week, but I just wanted that one to be out there because nobody asked that. I keep waiting for somebody to ask that, but nobody does. And I don't blame people because, how many times do you receive an inheritance and go through that emotional thing? Why would somebody ask that? Are they planning for that? But
yeah.
It is something to think of. All I got left is a recommendation, so keep going with whatever you got.
I got one more thing. I feel like I talk about this every week, but just interesting stats on this. So SpaceX, this is from, I'm going to mispronounce this. Can you pronounce this for me?
Yeah, the Kobisi letter.
The Kobisi letter?
Yeah, I don't know.
SpaceX, 2.5 times larger than Saudi Aramco IPO. So basically, this letter...
And just so you know, that Saudi Aramco IPO at the time, we were like, what? How big is it? It was huge.
It was 2019, and they're saying, breaking, SpaceX is now expected to raise as much as $75 billion in its IPO, which would debut as soon as June 12th. That's 2.5 times larger than Saudi Aramco's IPO, the current largest IPO ever. Nothing in history has ever come close to what SpaceX is about to do. So I keep bringing these stats up because it could get real interesting in June. I wonder if they have this priced in right. If they do, that's amazing. It's because either they have this priced in right, and that is amazing if it eclipsed Saudi Aramco's in a span of 7 short years. If they don't have it priced in right, I wouldn't want to be a SpaceX investor.
Yeah. So this is just an opinion, but most of these massive IPOs, when they first launch, not all of them, but I have a feeling it might happen with SpaceX too. Who knows? But they launch, and the initial launch is great, and then after a short period of time, the stock kind of falls and digests and gathers itself. And if it is going to be a successful company, it goes on to bigger and better things. We saw that with Facebook, with Google, with so many of these big IPOs. Now, none of them has been as big as the SpaceX. And also, the other thing with the SpaceX is, I don't know about you, I'll get a lot of questions. How do I buy SpaceX? How do I get into SpaceX?
Yes.
It's like, listen, it's going to be so huge when it does IPO that if you've got a diversified portfolio that includes stocks, you're probably going to have it.
Just by default.
It's going to be too big not to own. It's one of those things. It's not this under the radar little small micro cap company. This is going to be a core holding for better or worse because it is absolutely massive.
And here's another thing that I think of when I see stats like this is, and I'm sure watching like 5 years, I'm gonna be corrected on this, but what is gonna surpass SpaceX if they do raise as much as $75 billion in its IPO? I mean, something will. It's just that's insane.
There's always going to be.
There's going to be some AI company or something that's gonna
What quarterback in the future wins more Super Bowls than Tom Brady? Somebody.
I probably won't be alive for when that happens. I think that's
but I mean, the world gets bigger, stronger, faster, and eventually Hank Aaron's home run record and all those types of things. Things get broken. It's SpaceX. I got a mild recommendation. Fun. Started watching Marshalls, a series.
It's Taylor Sheridan, right?
Taylor Sheridan produced it. It's on CBS, and you can stream it on Paramount Plus. That's where I've been watching it, on Paramount Plus. It's Luke Grimes, of course. It's a good show. It's a little formulaic. You kind of can see some of the things coming, but it's fun.
Is it pre or post Yellowstone?
It's post Yellowstone, so it's a Yellowstone spinoff. It's basically a modern day Western crime show. It's fun. Good show. Good for a watch. If I come home tired, and we'll sit down and watch it. I don't have to. It's not like watching Inception or something where it breaks my brain. It's an easy watch. Just enjoy it. Easy watch. Fun time. Good show. Good show. Not as good as Lioness. I miss Lioness. I know it's coming again, but good show. Has a similar feel. Somewhat similar feel. I shouldn't say that. This is Western, and Lioness is a little different than that. Lioness has better action in it. So good show.
Yeah. I
Marshalls
have been wanting to start that. I've just been busy. I don't really have any recommendations, but I'll start watching Marshalls. That sounds good.
Yeah, it's fun. Yeah. If you liked Yellowstone, you'll like this. This doesn't have as much depth and heart to it as Yellowstone, but still a fun watch.
Yeah.
It's funny. I didn't watch the end of Yellowstone, the end of the last season or much of the last season, and part of it was because there was a lot of backlash, and when I went to watch it, I just kept pushing away from it. But because this picks up where that left off, I find myself Googling what happened at the end of Yellowstone because I'm missing pieces of the story for this show.
I mean, I've not seen Marshalls. I watched the end of Yellowstone, but I can't imagine what's in Marshalls that you would have needed to see the very last 2 episodes of Yellowstone for that you couldn't just Google.
You have to Google it. Yeah.
I don't want to give any spoiler alerts away for Yellowstone, but I watched the whole last season, and Kevin Costner's departure from the show, I think, just left the final season a little bit, I don't know, in shambles. If he was in it, it would have wrapped up a whole lot better. It was just, even just the first episode, the way it started off, you were just kind of like, oh, don't do this to this show. It's kind of sad to see. So
yeah.
All right.
It's tough to replace a key character like that. It's really impossible.
It is. I mean, like,
and just
there's so many amazing characters in that show, but he was the character. He was the main guy. So yeah. Well, thank you guys again so much for listening. Please continue to send us actual listener questions, not fake ones. And have a great Memorial Day weekend. We'll see you next time. The Capital Clarity podcast is presented by FA's Keith Wagner, AA, MS Financial Advisor, and Rick Wagner, CFP, Senior Vice President, Wealth Management. This podcast is for informational purposes only and is not intended to be taken as financial advice. All opinions expressed are of the hosts and do not necessarily represent those of Raymond James. Opinions are as of this date and are subject to change without notice. Investing involves risk, and you may incur a profit or loss regardless of strategy selected. Prior to making an investment decision, please consult with your financial advisor about your individual situation. 2003 South Easton Road, Suite 100, Doylestown, Pennsylvania 18901, 267-742-3455, Raymond James and Associates Inc., member New York Stock Exchange SIPC. The S&P 500 is an unmanaged index of 500 widely held stocks that is generally considered representative of the U.S. stock market. The Dow Jones Industrial Average, DJIA, commonly known as the Dow, is an index representing 30 stocks of companies maintained and reviewed by the editors of the Wall Street Journal. Inclusion of these indices is for illustrative purposes only. Keep in mind that individuals cannot invest directly in any index, and index performance does not include transactions, costs, or other fees which will affect actual investment performance. Past performance does not guarantee future results. 529 plans come with fees and expenses, and there is a risk they may lose money or underperform. Most states offer their own 529 programs, which may provide benefits exclusively for their residents. Please consider whether the state plan offers any tax or other benefits. Tax implications can vary significantly from state to state.